Yesterday, the trading day was jam-packed with the important events. Market sentiment is mixed in the middle of the week. Inflationary pressure has been ebbing away in the United States, though at a slow pace. Obviously, the ultimate target range of the Fed's funds rate will be higher than expected. The US stock market survived the tough 2022. Investors reckon that the worst has been left behind. InstaForex experts are ready to present their red-hot forecast for the American session. The benchmark stock indexes gyrated yesterday and closed mixed. The Dow Jones fell by 0.46% intraday. The Nasdaq extended its growth and closed 0.57% up. The S&P 500 edged down by 0.03% to close at 4,136 points. The major stock indexes traded quietly, drifting lower in the pre-market. The S&P 500 is expected to trade in the intraday corridor between 4,070 and 4,140 points. The stock indexes closed mixed yesterday because the US CPI showed that inflation got stuck at high rates. The consumer price index rose to 0.5% from a month ago, in line with the expectations driven by an increase in rent and the food prices. Consumer prices accelerated by 6.4% in January on year, a downtick from the 6.5% growth in December. Analysts had projected a lower CPI at 6.2%. Stubborn inflation assured investors to revise the peak of the official funds rate, and now the market expects the ultimate size at 5.28% by July. Investors stoked fears in light of hawkish comments by Richmond Fed President Thomas Barkin and Dallas Fed President Lori Logan. Barkin said that the central bank should give priority to the fight against inflation, but not to risks to the US economic growth. All of them said on Tuesday that the central bank should go ahead with the gradual rate hikes to curb inflation, and suggested that tough inflationary pressure fueled by robust hiring could lead to a stronger increase in borrowing costs. Following a bunch of comments from the Fed's policymakers, Deutsche Bank upgraded its forecast for the ultimate federal funds rate to 5.6% per annum. Besides, some market participants predict higher interest rates at even 6%. On the corporate front, Boeing shares rose by 1.3% yesterday to the highest level in a year, after Air India announced a deal to purchase 220 passenger aircraft. Coca-Cola shares slipped by 1.7% despite the upbeat revenue forecast for the whole of 2023. From the 11 sectors in the S&P, 7 went down, and the real estate sector incurred the biggest loss of 1.08%. The consumer goods sector declined by 0.95%. Today, Wall Street is still digesting the inflation data, remarks by Fed's policymakers, and their influence on the stock market. The major stock indexes traded cautiously because the market was anticipating the retail sales data for January. Looking for clues to consumer spending, the U.S. retail sales unexpectedly jumped by 3% on months, following a 1.1% decrease in December. It's the strongest growth since March 2021 and much higher than the consensus of a 1.8% increase. The core retail sales, excluding cars, gasoline, building materials, and food, climbed by 1.7%. The report confirmed that consumer spending remained buoyant following a decline last year amid the healthy labor market, growing wages, and the signs of easing inflationary pressure. Bearing in mind the inflation data released on Tuesday and the comments by Fed's officials, the US stock market is facing a bleak outlook. Apparently, investors will have to revise again the ceiling of the funds rate in light of the retail sales report. Monetary tightening is likely to last longer with the higher interest rates. The question is whether investors are ready to slash away risky assets to sit out the bear market. Berkshire Hathaway, run by Warren Buffett, cut its stake in a Taiwan-based TSMC chip factory and in some banks in the fourth quarter. In parallel, the company expanded its assets in Apple. Apple shares traded in the red in the pre-market. Tesla shares added more than 2% before the opening bell. Investors cheered the statements by Twitter CEO Elon Musk. He said that someone else would be perked at the end of 2023 to run Twitter, but first he needs to stabilize his social media company and to ensure its sound financial performance. Market sentiment on Wall Street could be sensitive to quarterly reports by heavyweights such as Cisco, Analog Devices, AIG, and Biogen. Some corporate reports will hardly save investors from the gloomy mood. In the currency market, the US dollar advanced across the board yesterday. Stubborn inflation in the hawkish Fed's agenda enabled the US dollar index to recover by 0.6% to 103.90. The intraday corridor for the index is defined between 103.50 and 104.20. The greenback gained ground yesterday following the strong US CPI and the hawkish comments from the Fed's policymakers. The Fed Watch tool predicted in December that interest rates would reach their peak at 5.1% in 2023. Now the future makes expect the higher funds rate. The new forecast suggests that Federal Reserve will raise interest rates 3 more times to the target range of 5.25 and 5.50% by July. Another factor to assure investors to revise forecast is that U.S. President Joe Biden appointed Fed's Vice Chair Lael Brainard as the new director of his National Economic Council in the White House. She advocated for rate hikes until recently, though cautioned against too aggressive tightening. So the dovish policymaker left the Federal Reserve and the camp of the hawks becomes more influential. This is bullish for the US dollar. Fresh statistics on retail sales reinforces the bullish outlook for the greenback. The question is whether the US dollar index has enough momentum to settle above 103.90 in the medium term. Market sentiment on the Canadian dollar is a clear cut today. Apart from the firm greenback, the loonie is wound down by a fall in the oil prices. The USD card pair is trading at about 1.3410, having gained 0.6%. The currency pair is likely to hold in the corridor between 1.3380 and 1.3470. Crude oil is trading lower today because the industry report indicated abundant oil inventories in the United States. The US stocks expanded more than expected by 10.5 million barrels. Brent crude slipped by 0.8% to trade at $84.68 a barrel, and WTI futures stumbled by 1.07%. Oil prices came under pressure after the White House stated their intention to sell 26 million barrels from the national strategic reserves, which had been already at the lowest level in the last 4 decades. The oil market found modest support from a report by OPEC released on Tuesday. For the first time in a few months, the cartel upgraded its forecast of a global energy demand. It also downgraded the forecast of supply from the non-OPEC countries, citing tough market conditions in 2023. The International Energy Agency provided a report today, having upgraded its demand forecast for 2023. As for the crypto market, Bitcoin managed to halt its fall and rebounded above $22,000. The token climbed to $22,600 intraday. Waning concern over the crypto regulation is an important factor to support digital assets. The global crypto market recovered to its previous value, which is now measured at more than $1 trillion. Glassnode reported that long-term crypto investors are poised to keep their tokens. Nowadays, the total value of bitcoins, which have been out of circulation for at least 10 years, has reached a new record of 2,634,631 tokens. If Bitcoin is able to reinforce bullish momentum and close above resistance of $22,500, this could indicate a trend reversal. Under this scenario, the next key level will be 24,300, and the intraday corridor for Bitcoin is seen between $22,000 and $23,100. Keep close tabs on financial market with the InstaForex analysts, and good luck in trading. See you online tomorrow.